Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields keep creeping higher. In fact, we got to the highest this week that we've seen since September of 2014, kind of getting through that obstacle of 262, 263 yield, something that we've had struggled to do over the last year or so. So we got through that, we pushed through. We didn't see really any kind of a pullback once we got through that key resistance. Typically when you hit a key resistance level, you break through it, and then you kind of see the market drift backwards the other way, possibly with profit taking, possibly with those looking to fade the move. But we didn't see that in Treasuries today. And I think that Treasury market right now, the momentum to higher yields and lower prices remains very much in place. It's been a very much of a technical breakout, and it hasn't seen any kind of reversal yet. I say yet because there was always a reversal on the horizon. It's just a matter of timing. And so right now, I think that the bear market in Treasuries, so to speak, should remain at least until we get some evidence or some news that tells us to go the other way, and that we do have coming up. We do have a new Fed chair stepping in next month. He will give a testimony to the Congress for the first time next month. We also have some key data coming out for fourth quarter. We've got GDP next week. We've got central bank meetings in Europe and in Japan. So there's a lot of things going on. Not necessarily that will all move the tide in Treasuries, all individually, but together you could start to see things move a little bit. So right now, Treasuries still looking for towards higher yields, but I think we might be near that near-term top, at least until we get past some of these big events. And if you look at what's happening in volatility as we get ahead of some of these big events, as the market continues to push to newer territories and higher yields, volatility has slowly been creeping higher. Not huge, but we're not seeing volatility levels that we would see perhaps years ago ahead of key events, but we are seeing volatility off the lows, and that's a good thing because market volatility has been so low. You've almost been asking yourself, why is the market not at least concerned about what's happening, or the unknown of what's happening, or perhaps a reversal and back to flight to quality, or something with supply, or something with the Fed. There wasn't really any concern priced in the Fed, and there still isn't, but we're starting to see it uptick. I think that's a positive thing. At least it shows that there is going to be some defense out there. I think over the last several months, we've seen very little of that, and therefore the market is just traded with really no fear at all. And lastly, we look at the yield curve. That's been really the 400-pound gorilla in the room when you talk to the policymakers at the Fed, in that those 2- and 10-year yields right now trade about 57 basis points apart. 50 was the low earlier 2 weeks ago, and we've seen a little bit of steepening off that. But if you look at the big picture, you get 2 Fed rate hike tightens in the next 3 to 6 months. That 2-year yield is going to go very quickly, and the 10-year yield is just not going to move that fast. In fact, it could start to go the other way. If that's the case, you could see a flat or possibly inverted yield curve, something that the Fed does not want to see. And the uncertainty of that remains very static. Another reason why I believe volatility should be higher is that the fear of the yield curve going inverted would send too many mixed messages. I don't think the Fed wants that. I think that will be addressed specifically when Jerome Powell sits down in front of the House Finance Committee and Congress next month. I think he'll talk about the yield curve and possible ways the Fed will look to continue to keep it from getting flatter. So right now the yield curve, seeing a modest uptick, seeing a little bit of steepening, but still very flat, and too flat, I think, for what the Fed wants moving forward. So next week we get Fed central bank meetings, we get fourth quarter GDP, as well as we'll start to talk about the January 31st FOMC meeting. That will be Jenny Yellen's final meeting as Fed chair. This has been Todd Colvin coming to you from the floor of the CME Group.